First, Andrea asked a question earlier this week. I did reply to her by email, but I have not heard back from her. So I'm just going to do this presentation here to discuss it in case you missed it. So earlier this week, she says, I want to talk about a subject you might think of interest for the usual Friday webinar. I opened an IWM short strangle, strike price of 167.50 and 181, expiring on tomorrow, she said. So it was this was on the 5th or the 6th, I believe. But we're going to look at it as if it was the 9th, today. And she opened this trade when the ETF was around 175. Third strangle in the row, and the first two expired worthless. She says, I didn't check on the dividends. They were yesterday. The price jumped up very quickly, and I was assigned the short at 181. If you're a little bit lost, don't worry. We're going to cover what the strategy is, rights and obligations, and this position. And the current loss is around 550. Her sentiment is that the price will go back into the trading range it has followed for weeks, but I don't like the idea of being exposed to infinite loss. It would be helpful if you could suggest some ideas you think there are on repairing this situation. Let's talk about the short strangle itself. A short strangle is a leveraged strategy that's high risk. You're going to sell an out-of-the-money call and at the same time an out-of-the-money put with the same expiration on a security. You're not going to buy the outside wings as you would in an iron condor. So the comment that was made that I don't like having infinite risk after I was assigned the short call, which means that what came up here, this was a short call position, a naked call essentially. You're in a naked call and a naked put. Take on the same risks of a naked put and infinite risk of a naked call. So that's why you see the infinite risk here as well. Now, obligation of selling a call is you've entered a contract to deliver shares of stock at that price, just as you would in a covered call position. If you don't own the security and you're assigned, you're going to end up being short the stock, which also contains infinite risk to the upside if the stock continues to move up in price. As was mentioned, this is a neutral strategy. You won't need the security to stay between the two short strike prices so that both options expire worthless and you keep the net credit. These prices that I've got, and the prices that we have here, were based on doing the historical search on June 1st. So we're seeing a 70-cent net credit for the June 9th expiration, 167.5 put and 181 call. All right. Now, the comment was made that didn't pay attention to the dividends, lesson learned. Just want to remind everyone that on directional, neutral, leverage strategies, bull put credits, bear call credits, even debit spreads, short strangles, iron condor positions, which have a similar risk reward profile to what we just saw with the short strangle, but you have a known risk because you're buying a higher strike call and buying a higher strike put. So it's like a bear call credit spread combined with a bull put credit spread. You have a known risk. I'm not going to say low risk. You have a known risk. In these strategies, you should always avoid stocks that have earnings between now and expiration or potentially have dividends between now and expiration. And you can do both of that on power options in all of those strategies. Underneath the fundamentals tab in the search for any strategy, you have a selection for earnings date between now and expiration, between now and next weeks or now, or not between now and expiration. IWM, we don't have to worry about the earnings, but we have that ex-dividend date there as well between now and expiration and not between now and expiration. This wouldn't have saved the position because this is looking at ex-dividend date, not the payment date. But if the ex-dividend date was crossed, and that's why the buying happened, because investors, I should say, wanted to be on record of holding the stock to get the dividend down the road, that's what you maybe wanted to avoid as well. But yes, we always want to do due diligence, lesson learned, so we're good to go there. Again, let's look at it again. From the historical search June 1st, using the historical prices. Short strangle position on IWM. Remember, the stock was at 175. I believe on June 1st, it closed at 170. 558. It was just looking at the closing prices. So in that wheelhouse we're talking about. The 181 call was priced for June 9th, expiration was priced at 13 cents, and the 167.5 put was priced at 57 cents. So we're going to get a net credit of 70 cents for selling to open both legs. And that's the maximum profit. If the stock stayed between the two strike prices, our sold call would expire worthless, our sold put would expire worthless, and we'd keep the net credit. That's not what happened. Now we're showing the total monetary requirement if this was a cash secured naked put and a fully secured naked call. One of the advantages of short strangles, similar to an advantage of an iron condor, but in the case of the short strangle, the margin requirement brokers is a little bit different. It tends to be some combination of the call strike price plus the put premium and 1/3 of that value or 1/2 of that value, depending on which broker you are. And you usually need to be up at level 4 trading for most of these strategies, these types of positions. Some are maybe level 3, but most I've seen are level 4. In any case, that's what we're looking to accomplish. The return looks very small, but that's because it's an exaggerated total requirement here, as I mentioned, shown on power options, where your broker is probably going to be vastly different for the margin requirement they're going to have. Now, what did IWM do over the 5 days I used? The actual position might have been a shorter term. But as I mentioned, from June 1st essentially to today, that's when the stock was trading right around our 175 range, where we got in the position. There we are at about 175.60. And the next day it moved up. On the 2nd, it moved up to about 182 and then came back and closed here at about 179.60 or so. Then, as mentioned, ran up to 184, ran up to 187, and then came back down today to about 186. I think it closed at 185.03. So, things that we want to consider here. In spread positions, we discuss the 1% rule. Looking to potentially close, adjust, or roll the position if the underlying reaches within 1% of any of the sold option strike prices. For a bull put credit spread, it'd be 1% of the sold put strike. For a bear call, it'd be 1% below the short call strike. I don't want to allow it to go in the money. Why I have this one selected here on June 2nd, and again, we don't know what date the position was actually open. It's not important. We're using an example if we opened it on June 1st. It could have been opened days before that. But at this point, when the stock breached 182, or as I'm watching the trade here, and it goes above that 179.19, I'm considering adjusting the leg that's being threatened. And at that point, it's our 181 strike. I don't want to be standing in the way of the freight train if this continues to move up, because I do still have infinite risk to the upside by definition. Now, the second day it pulled back a little bit, but it closed even. Yeah, it dropped down to 178.80, but it still closed above that 1% rule. If I didn't adjust it on the first day, I definitely would have been looking to adjust it on the second day. Got a little bit of a breather. Maybe I can do something with this position. And then it gaps up, of course, and we're in that structure. Now we're in that risk of being assigned early, as what did happen. Now, moving forward, short strangle by itself. Just a short strangle, not the position that happened and the question was asked. Similar to some of the ways we show to manage a credit spread. Number them out. What adjustments might we use if I'm in a short strangle position and this happens? Number one, now you have the choice to do nothing. Hold and hope that the pattern will change. The security will readjust back to the previous levels, as was mentioned in the email. What's the risk in doing that? The stock continues to move in that one direction, and your small $500, $600 loss becomes much larger. Number two, close the spread when the triggers are hit and take the loss. When it breached the 1% rule, sorry, let me go back one. I apologize. I believe what I was referring to here in this note, this slide here, is on the second day, on June 5th. So over the weekend, it was above it. June 5th came up. We got a little bit breather. That was on Monday. Okay, so on the close of June 5th, the cost to buy to close the 181 call for June 9th was 93 cents. Remember, we took in a net credit of 70. And the cost to close the put was 4 cents. So, I'm sorry, it would have been a loss of 23 cents in that scenario. Keep the 70 cents. Got to pay the 93 back. So we're down 23 cents, excuse me, and another 4 cents. We're down 27 cents total on this position. Number 3, roll the threatened leg. On June 5th, I could have bought to close the 181 call for 93 cents, sold to open the 184 for 30 cents, which would put me in a positive net credit of 7 cents. But unfortunately, we saw what happened. It still went up to 185, so it would have cost us about $1.05, $1.06 to close this position at some point today. Maybe a little bit more, maybe a little bit less, depending on where it was. So we would have been at a significant loss in the position again, compared to the net credit we were looking to achieve. Number 4, close the entire spread and move the position out in time in different strikes. This step includes liquidating the spread, so we'd realize that loss, 27 cents. Now we have to go out 2 weeks, 3 weeks, or 4 weeks to find a reasonable strangle, reasonable range out of the money that still gives us a 27 cent. Actually, I'd look for about a 40 cent net credit in that position to at least be half of what the original expected return was in the strategy. If I wanted to get much more than that, double the net credit, I'm probably going to have to go further out in time or increase the number of contracts I'm using, which is going to increase the margin requirement for the trade. And I'm talking about monetary, not the hard net credit, but the monetary value. Number 5, close the entire spread, as we would in number 4, and open a credit spread in the direction the security is moving. Follow the sentiment. Yes, the trend is your friend until the trend ends. Well, the trend ended. You were in a neutral range, and you felt that going this range far enough OTM was going to be good enough to stay within the recent trading range, but with news that came out, debt ceilings, agreement, things of that nature, AI, some other earnings that came out that were positive, IWM and the SPY QQQ exceeded expectations, I'd say maybe in the past week, following what had happened in the 2 to 3 weeks before. So it's moving up. It's moving up against us rather than move the entire strangle out, which is still a neutral position on a security that's moving up. Follow the trends, perhaps, move into a bull put credit spread, looking for that 50 or 60 cent net credit to try to get back to the original expected return that you were hoping for, or at least half of it, potentially. But there's problems with all of these. There are problems with any adjustment in any given strategy. Any rolls or adjustments on spreads still have risk in some direction. The trend is my friend until the trend ends. I move this strangle into a bull put credit spread 2 weeks out in time with the net credit that I want, and it does start to go back to where we saw before based on the expectation from the email where it reverts back, and now my bull put credit spread is being threatened. Maybe I could have rolled to a bear call in that case, but it's against the current trend that the market and the underlying is showing us at this time. With any strategy, any adjustment in any strategy, you could potentially take a higher risk with the management if the stock reverses or does not follow the desired sentiment strategy. This is why it is sometimes better to just close the position. We were wrong on the direction this time. We don't want to try to over-manage it. Yes, we want to not take a loss. That's desirable. We want to manage the loss. That's absolutely desirable. But if the sentiment, the stock is exceeding our initial sentiment, if it's not behaving in a direction that we feel comfortable in trying to pick, as long as you've studied IWM or Apple or IBM, something is happening here that you can't follow it, just close the position. Maybe look for a different underlying that matches the sentiment if you want to continue using the strategy in your portfolio. Now, all that being said, of course, the follow-up comments, this was just for a strangle discussion, which was related to the initial question. but the main point at hand was the price jumped up very quickly and I was assigned short at 181. In this case, naturally, as I mentioned, the position now is a short stock position with a sold put that, yes, expires today, expires tonight. You're in a covered put position. It's the reverse of a covered call. So you might be able to apply similar management techniques with the reversed ideas to the covered call management to manage your covered put. You might just want to, you said you're down 550. Well, you might want to roll the put out, buy to close the put. The stock's at 185. Maybe you sell to open a 183, maybe a 184 or 185 call, maybe a couple weeks out, and try to get $200 or $300 and keep selling the put against the short stock position as a covered put. Now, this is a directional trade. The covered call is neutral to bullish. The covered put is neutral to bearish. You would end up being short stock in that strategy, though, if you were signed early. So again, you have to make the decision if that's something that you would want to do. But if you stay in the covered put, you can manage it, or you can just close it and take the loss. Maybe open a new strangle if you think it's going to settle. Open a new strangle at different strike prices. But again, I don't know if you want to trade against the trend right now. If you can't get a gauge and you're hoping that IWM is going to revert back to those lower ranges and it keeps going up, continuing to trade strangles against it naturally could compound your losses of what you're trying to do with the security in your portfolio, and that's not a good way to go. The beginning of the email started off, but I didn't include that in the thing, but the initial comment was in a webinar I was watching some time ago, you said you don't like messing around with short strangles. Not these exact words, but that was the idea. And I think you can kind of see why. I prefer to have known or controlled risk on my trades. Married put positions, collar positions, credit or debit spreads, which again are a known risk. Never call them a low risk because you can still overtrade with the leverage and get yourself into trouble. Even with an 80, 90% probability bull put credit spread on a stock that's been moving up, if I put 50% of my portfolio into that position, I can easily lose 50 to 60 to 70% of that, even with a 90% probability. All right, so that's where the importance comes in for proper asset allocation with anything you can lose 100% on, or anything with a limited risk. It should only be a small portion of your portfolio. That's why I don't like messing around with short strangle positions. And it's just because the infinite risk on either side does not suit my risk tolerance, my trading goals. But again, those are some ideas. I know we didn't go through a lot of the ideas on managing the position you're kind of in now with a covered put structure. If you're now short the stock, you still have that short put. You can trade it just like you would a covered call position, but think reverse. I'm short the stock. I can sell puts out of the money or at the money to try to knock down the loss I have on the position. But remember, as you mentioned, and per your sentiment, not saying it's mine, and I'm not saying either one of us is wrong or right, per your sentiment, if the stock does start to revert back down to that 175 range, I should say underlying, or I should say ETF, I apologize. But if it does move back down that 175 range, you could keep generating income against a short stock position with the sale of the put, creating that covered put structure. But the risk, again, is if it keeps going in the wrong direction, you have infinite upside risk on the trade with the short in the underlying of IWM. So I hope that helps out in some way. And of course, if you have any other questions, you can send me an email at any time. I did more insight into this than was into the initial email that was sent, I think, on Wednesday. Maybe it was Thursday. It was Wednesday or Thursday. I apologize. But if there's other questions that come in or other thoughts that come in, please let me know.